Hi. I just wanted to sort of share this video with you primarily because what I'm seeing nowadays is that people from in the younger generation who are in the early 20s or even people who are in the teens, early 20s, early 30s are coming back and telling me that they are more conversant or they are happier consuming uh, you know videos, whether they are short, long, whatever, compared to reading long form articles. On the other hand, I am personally more conversant, or I am happier writing. So what I will essentially do going forward is I will keep writing articles or thoughts and share them, and I'll also try and record these as these monologues and videos, so that it becomes easier, and the choice is up to you whether you want to read it as a written document, or whether you want to listen or hear, watch or hear this as a audio or video format. Uh, so why today's video is basically about and I'm recording this on the 16th of April 2024. Just 2 days back on the 14th, we had Paula Boishak, the first, the Bengali New Year's Day. And I just sort of, it hit me that it's been 5 years since I started Intelsense, and we sort of embarked on a new journey uh, of being a full-time investor. And it's been a wonderful last 5 years, a lot of learnings, and I thought I would share some of the journey and some of the learnings through this article and through this video. So, okay, the other important point about any video I make is I'm typically, not reading from a script, or I'm just impromptu. After I've written the article, I have a sequence of thoughts, and I'll sort of be speaking, just from the cuff. And sometimes what will happen is I will maybe add uh, things which are not there in the article, and maybe sometimes I'll forget something that I've written about. So it may not be a 1:1 match between what I'm writing and what I'm speaking about. So with that aside, let me get started. So I spent 2 decades, nearly 2 decades, 19 years. I started my IT career in 2000. Spent the next 19 years essentially in two companies, 2 years in one, 17 years in the next. And by 2010, 11, 12, I was pretty much you know wanting to get out of the job. By 2016, I had made up my mind. Convincing my family, especially my mother, was extremely challenging because I come from a typical Bengali middle class family. uh, Job security is of paramount interest to most people in my socioeconomic background, and of course I'll not deny it, but the lure of the month end salary, the SMS that you get at the end of the month, at the beginning of the month, uh, is actually very very addictive, right? It becomes very difficult to let go, and especially people like us who are working in IT, getting reasonably high salaries. uh, it became it sort of like felt like, should I do this, should I not, because the career had by then sort of gone on autopilot, and I was anyway doing investing on the side, pretty much. In fact, the last 10 years, of course, before 2019, at least 7 8 years, I was spending at least 7 8 hours a day doing work related to investment, writing, etc. So the last, I think, decision point was mainly when I thought that there's no point in continuing to do what I was doing. I was looking at my seniors who were like 5 years, 10 years senior to me in my organization, and I was pretty certain that's not what I want to do for the rest of for the next 10 years. So and I was doing reasonably well in my investing. So I thought it's better to leave my job and just focus on what I do, what I like doing. And what I did not realize when I was taking that decision is being a full-time investor is not a very easy thing to do from an emotional perspective. Because what tends to happen is that, especially if you're a long-term investor, you don't have anything to do every day, right? I mean, one a friend of mine told me that Abhishek, when you're leaving your job, make sure you're not working from home. You have some other place to go to. So you get up, wear a uh, you know wear office clothes, go out of your house, and even if you're sitting alone, you know hire a co-working desk or something, and just go out, because if you're sitting at home and working, it is going to be challenging. And I was lucky because I had a childhood friend who sort of immediately called me. He said, Abhishek, you come and sit with me, because that it will be good for both of us. And I started doing that from day one. That was very helpful. And uh, I think the biggest problem is that when you are leaving your job, and this is something that people don't sort of anticipate, is all your friends are working somewhere, either they're in a job or doing business. So, and you're a full-time investor. Sometimes you don't have anything to do in the morning, but there's nobody else around, right? I mean, who can spend time with you. So it's a very lonely kind of endeavor. You need to have like-minded people who you can interact with, people who you can share your ideas with. Luckily, I have some very very good friends who are very accomplished investors themselves, who I can speak daily, more than once a day. Uh, so that sort of helped me. The challenge and what drove me to start Intelsense was essentially two things. One is I personally am a very curious person. I have a lot of interests, whether it is history or sports or social psychology or behavioral psychology, history, uh, geopolitics, and my challenge is, if I start reading something and I'll get into that rabbit hole, and suddenly I'll find spend 5 days or 10 days just reading up on something which is esoteric. uh, and I was slightly afraid that I will end up doing pursuing all these very diverse things, and investing would take a backseat. And the second thing which sort of drove me was the last 10 years, I think, since we started Value Picker in 2010, last decade, had the opportunity to interact with a lot of investors through Value Picker, through different forums where I used to go and speak. And what I found is that investor awareness, understanding was fairly low, and most people were trying to run after stock tips and not really uh, trying to build up a mental framework for investing that will help them over the next 10, 20, 30 years of their investment journey. So I thought that, since I started with practically nothing, I started with 5,000 rupees in 2000, and when I was leaving my job, I thought that it would be a good idea to be able to give back to the community in terms of knowledge sharing, what I have received. And uh, other factor which was playing in my mind is, when I started, I practically did not get any help from anywhere. So it was just, I think, one or two sources was there. Ramesh Damaniji used to do, uh, I think, Tuesday chat on Rediff, where he used to take questions uh, from investors. Other than that, there were not too many interactive forums, or there were not places where people could actually, go and listen to someone uh, who's sort of been there, done that kind of thing. So basically, I thought that that was a space where I could maybe contribute my two bits, and that sort of these two, thoughts of being disciplined myself in my work and sort of give back to the community is what drove me to start Intelsense. And when I started this on 15th of April 2019, I was sort of with the frame of mind that if I have uh, you know 50 people who would subscribe, I would consider this a great success. And interestingly, what happened was, even before the sort of website, I think the website was just up, but I had not sort of written about it. I've not done anything, and I suddenly found that subscriptions started trickling in, and I actually reached out to the first two three people, saying that how did you come to know about this? And they said that we've been following you on Value Picker or on ET, reading your articles on Economic Times, etc. So it just came up because your site was up, your name was there, sort of subscribe. And within, I think, the first week, maybe first 2 3 days or first week, I don't remember now, all that, well, we crossed 50, and then we kept trickling in uh, continuously after that. So beyond, after it went beyond, I think, the first 100 or 200, I sort of thought that this now needs more serious attention. And that's when I really started thinking about doing this well. And not that I was thinking I'll not do it well before, but then I hired somebody initially, started to think in terms of building up the team, etc. And even today, I think we don't have a very large team. And one of the reasons why I do not believe in having a large team is because history has taught uh, us that investment is a single player game. It's not a multiplayer game. You cannot do good investing by committee. You cannot have 10 people uh, do do investing. Ultimately, as a fund manager or as an advisor, your uh, as an investor, the buy and sell call has to be based on your conviction. And to build up conviction, you have to do the due diligence yourself. You cannot outsource it to a few analysts in the team and say and believe that you can buy and sell based on that. You can do that probably if you are a fund manager buying only Nifty 50 stocks or something like that. But the space that I am most comfortable in, which is mid caps, larger mid caps, even some small caps, that is a space where you need to do your own due diligence. You spend time understanding the sector, understanding the company, etc. So even though now I think we've got a very small team, the idea is to use more and more technology uh, for doing the stuff that most institutions like mutual funds, etc., do manually. Uh, the next thing that happened, over the next following 5 years, is I started with the long term strategy, because that is what I knew well, I was good at doing. Uh, and by, I think, 2018, I had started exploring quant, exploring technicals, and sort of slowly beginning to find a foothold. And then we started Quantamental, which was essentially two strategies, uh, one with absolute momentum, one with relative momentum. We started Hit Picks, which is more techno funda. And the realization for doing all this was to basically, you know, understanding the fact that markets are not, the performance in markets do not come from a single factor. Now, when I talk about a factor, I'm talking about factors like value, growth, momentum, GAR, dividend yield, etc., etc. So it's not, you will see, markets going in phases. Sometimes value does well, sometimes growth does well, sometimes momentum does well, sometimes quality does well, and you will see this, uh, you know, the styles also, investment styles or strategies are cyclical in nature. So once that realization came, what I then realized was that if you have a basket of strategies or a mix of strategies, then you will not have the best performance of any of the single strategies that you have. So for example, let's say sometime value is doing phenomenally well. uh, if you have a mix of strategies, you may not do as well as your best performing strategy, but you will not do uh, as bad as the worst performing strategy. And I think that is a very important thing. If you see the last few years, quality has done performed exceptionally bad. Now, if you have a if you are a quality based investor, then you know you would have been taken to the cleaners in the last 2 3 years. But you also had a great time between 2018 to say 2020, and beyond 2020 onwards, I think things have started turning really really bad. So the point here is you have to. That was my realization, that you have to have multiple strategies. You have to have your finger in the pie, your finger in the value pie, in some growth, in some momentum, and so you have a mix of strategies. So that is what I started sort of focusing on. One thing led to another. Then the next realization came is that you need to be able to concentrate, right? If you have a uh, you know so my normal is I never used to have, I always used to have between 15 and 20 stocks, usually never above 20, usually never below 15. And my logic was always, or continues to be, that in a longer term basket, you should have roughly 15 to 20. That's what my thinking. Currently I believe it is roughly around 10 to 20, uh, where you can diversify away your risk. Now, what I started doing was I created a small case specifically where I put in all most of the learnings that I was getting into one basket, and I started running it myself to see how it would perform. I sort of, and because this was not pure quant, you cannot back test, right? You cannot, if you have some amount of discretion, that strategy cannot be back tested. But I did some amount of forward testing, and intuitively it started, I think, doing well. And so Quiver was born, and I think to a certain extent of the duration that it has been live, I think it's been about 3 years. It has been the best performer across all the strategies that I've been running, uh, because it combines value, it combines growth, it combines momentum, it combines concentration, all in one thing. I am sure it will also underperform at some time, but I'll have to see how and when that comes, right? So that's again a work in progress. The next phase came when started getting a lot of requests from existing members saying that why don't you start a PMS, because doing all these transactions etc. is a difficult thing. uh, so I always sort of thought about it, but see, one of the reasons why I left my job is I did not really want to do all the management stuff, in the sense that I didn't want to manage 20 people. I didn't want to do a lot of operational stuff. So, and most of these, PMS, etc., require a lot of operational overhead, which was something I was not really interested in doing. I am really happy reading, writing. I don't know. these videos I'm doing new. I don't know whether I'll enjoy it or not, but let's see how it evolves. But I'm really comfortable. I love studying businesses. I love reading. I love writing, and I wanted to do that exclusively because that is what energizes me. And then eventually what happened was I tied up with a friend who was just beginning to start a PMS, and we sort of joined hands together, and we started the PMS again. In the PMS, I created two funds. I wanted to keep it simple, one long term basis, and the other which is more of a shorter term, short cycle, playing short cycles. So Shree, Lakhsmi, Shree, Vriddhi, and that's how we sort of structured the fund. Try to keep it as accessible to people as possible in terms of fee structure. Now, the next part was, that's where we are in terms of our journey. The learnings that the biggest learnings I cannot sort of maybe I may not have put in all my learnings, but I'll try and capture some of the most important ones that I have learned over the last 5 years while you know running Intelsense, while working as a fund manager, which is sort of, and while evolving myself as an investor, right? So first of all, like I already said, I think multi-strategy works much better than a single strategy. Most fund managers you will find, most mutual funds, PMS, etc., are all single strategy funds, and the reason for that is the fund manager or the individual. Like I said, investing is a single player game. So the strategy is based on that individual, right? So for example, like in tennis, right? You'll have a Rafael Nadal who is a backcourt player. He'll play from the baseline and hit. You know, he will be a defensive player from the baseline or an attacking player from the baseline. On the other hand, you'll have other players like maybe a Roger Federer who's more aggressive at the net. So it depends on the kind of individual you are and the strategy that you adopt. So you will find a lot of very accomplished investors who are good in what they do. So somebody who's a great value investor is doing really well in value investing. Somebody who's a growth investor, somebody maybe car, someone may be following momentum. So and there is no one path. It's like if you are able to investing performance can come if by following any of these strategies. So it's not that if you follow X only you will be successful. It's not that. I know of people who are traders who've been extremely successful. I know of people who are extremely uh, deep value investors who are successful. I know people who are pure momentum players who've been successful. So you have to keep an open mind in terms of what works in the market, and that is not something which is easy to do. What I found is that most people have a very closed mind. They only believe that only one thing works, and if they have been successful in doing that, or in following that one strategy, they believe that that is only thing that works, and everything else is not every other thing does not work. So that is something which uh, I have proven myself and to people around me that that is a fallacy. If you follow multiple strategies, it is you know multiple strategies work differently at different times, and you are better off having multiple strategies. So that was the first learning. The second most important thing that I learned probably is that investment psychology, how you behave, what your mindset is, what your time horizon is, that is the most critical when you are investing, right? If you have a long term horizon, if you are not overly exuberant or overly pessimistic at uh, you know different levels of the market. At all times high, you're not very cautious, or you're not really scared. Then I think that is what is most important. The other thing I have seen, and I think I missed this out when I was writing, is it is very difficult for most investors to digest big money. Uh, what I mean by that is, if you are just one second, laptop charges. So, what I mean by that is, if you see a 10 bagger or a 20 bagger, very few people are able to sit through a 10 bagger. If you buy a stock at 100 and it goes to 150, most people are itching to get out. And I've seen this multiple times. We've been lucky to have a few multi-baggers in the last 5 years that have gone up 5 times, 10 times, and every time a stock has doubled, I keep getting these emails saying that this has gone up so much, should we book out, and things like that. And so that is a very big learning for me. And intuitively for me, I've never had these problems, but after interacting with so many people, I see that this is a very big challenge for most people. And the only way I can think of is, you need to be able to uh, consciously sit tight on stocks that are doing well. The next lesson that I've learned over the last maybe 5 7 years is, a lot of people get over influenced by uh, US based market gurus. Right? A lot of people will read Buffett or Munger or Lynch, or uh, all fund managers or great investors. And I have probably read nearly everything relevant that Buffett, Munger, Lynch, etc. have written about. But what I have understood over the years is, you have to understand that these people were working in a different economic, different geopolitical, different social context. And what has worked for them may not work for you in the same manner. Markets have changed, the technology of the markets have changed, uh, time horizons have changed. So, just you cannot copy paste uh, what, say, a Buffett has done in the 50s, 60s, 70s, and think that you will be able to do well, right? You have to learn from mistakes, your own mistakes, mistakes of other investors, great investors, to those that are there in the public limelight. And don't follow anyone blindly, whether they are great investors from abroad or great investors within India. To understand that when somebody has become great, uh, he has operated in a different context. They've been there in the past. So somebody who's done extremely well in India probably is 60, 65, 70 years old today. Especially the great investors. And uh, you have to be able to reconcile your own psychology, your own mindset, your own time frame, your own risk taking ability, uh, and then create your own framework. And that, I think, is very critical. Most people just blindly follow what somebody else is doing. I think that's a recipe for disaster. uh, the next, I think, big learning was that it's very important to be able to manage drawdowns. uh, if your portfolio is down 10% or 15% or 20%, it really shakes you up. When you're sitting and the times are good, if I tell you that your portfolio is going to go down 15%, you will most likely say, that's not a problem, I'm okay with that. But when it actually happens, and everything around you, the news flow, the your Twitter handle, your WhatsApp groups are talking about chaos, and everything around you feels like it's going to fall apart. It's not easy to sit through 10, 15, 20% portfolio level drawdowns. So I think it's important to understand limitations of your own psychology and have strategies based on that, right? Because what is important is your persistence over the next 10, 15, 20, 30 years, that you should be in the market. You should never get into a situation where you are taken out of the market. That I think is a problem. If you are able to digest the ups and downs, uh, and be sure that over the next 10 years, 20 years, market is going to go up. If I look back, I started in the year 2000. I remember Nifty was less than 4,000. Right? Today it is 22,000. Sorry, Nifty was less, around I think 1,200. Sensex was less than 4,000, and Sensex today is at 70, 72, 70, whatever thousand. Nifty is up from say 1,000 to 22,000, so it's roughly up 20 times in the last 20 24 years, in last 24 years, which is phenomenal, right? So if you take a longer term view of your portfolio, not of individual stocks, your individual. So for example, look at me, right? I run a short term strategy where we are churning stocks pretty much maybe once a month or once a quarter, right? So it doesn't mean that your stock view has to be 30 years. It means that your investment view has to be for 20 years, 30 years, or 10 years. But you can change the vehicle. If you have a long term strategy, you might want to take a 1 to 3 year view. If you have a short cycle strategy, you want to take a 1 month to a 6 month view, or a 3 month to a 1 year view, depending on what your time frame is, what your risk you know risk expectation, or risk taking ability is. You sort of base your strategy on that. I think that is the important part here is to have a strategy which you gel with, and which you are able to stay uh, with for the long term. That I think is very, very important. And again, I'll tie it back to what I was saying before. Your ability to stick to investing is much, much higher if you have multiple strategies, because at any given point of time, something or the other will do well, right? Uh, the only basket I see, for example, I'm working on a mean reversion strategy right now. It's not yet up to a point where it can be completely quantified, but once I'm trying to get there. And then the last goal would be a shorting strategy. So once, if the market is going down, if you're able to capitalize on it, then I have a full basket across end to end spectrum, where you have a momentum strategy, you have a growth strategy, you have a value strategy, you have a mean reversion strategy, and you have a shorting strategy. So you are more or less sure of being able to make money irrespective of the market direction. So I think that is what will keep you in the game for the next 20, 30 years. The next learning is, again, when I speak to people, I think very few people have, I won't say a clear idea, I have even any idea about why they are investing. I think that is very important. You always start with understanding first principles, right? So understand why you are investing in the first place. That is very, very important. That will determine how you build your strategies, what kind of things you are interested in. I think one or two other things that I can quickly recollect. One is, don't take people's opinions and people's thoughts at face value. You should be able to sort of cross check it over data. Uh, if there is no data available, try to read as much as possible on the topic across divergent viewpoints. So somebody is saying, for example, let's say that say say steel is going to do well over say the next 1 year, 2 years. Just giving an example, random. So try to first gather some data, then try to look for people who are, who you respect, who have a positive opinion on steel, and then try to find thoughts of people who, again, who you respect, who have a negative opinion, and then try to understand what their main points are, and then draw your own conclusions from there. I think that is very important. And last, or maybe the second last thing, is keep an open mind. Be ready to change your opinions when the data changes. Markets are dynamic. Don't get stuck with a particular narrative. Don't get stuck with X works and Y doesn't work. Ultimately, for me at least, my objective or my goal is I want to make money in the markets. I am not here to be. I'm not here to teach investing. I'm not here to profess. I'm not here to do anything. I'm here to essentially invest my capital, try to find the best investments possible within the limitations of my knowledge and my mindset. And the last point, which I keep telling everybody, including myself, all the time, is capital is sacred. Don't lose it. Don't buy into companies where you have question marks in your own mind. Making less money than the index, or your friend or the guy sitting next to you, is not a catastrophe. It is not something that is going to change your life. Losing your hard-earned capital is what is going to change your life. Don't उस गली में जाना नहीं है. Right? Don't get into something where you are risking your capital uh, to a great extent. I think that pretty much sums up some of my most important learnings in the last 5 years. Thank you for all of you who've been part of my journey, who've helped me learn with your feedback, with your questions, and do let me know any thoughts, any comments that you may have. Thank you for taking out the time to listen to this.